Lecture 19 of Financial Reporting. So we are going to go through IFRS 9, which is financial instrument in this lecture. Before I start this lecture, let me tell you that this is one of the longer standard that you will ever come across compared to all the other standards in your entire financial reporting syllabus, and also one of the difficult part compared to other standards because it has so many parts in it. There are so many subtopics in financial instruments, and also it is a very complex the way it is dealt even in real life. But when you do calculations and all, when you practice your revision kit enough, you will be getting a hang over it, right? So when you start this topic, do not at all think that this is a topic that is impossible, or don't try to skip this topic. Why? Because even in your SBR, this is there, and in your SBR, it is even there are more things that will be dealt in, which will be not be covered here in financial reporting. For example, hedge accounting. It is not in your financial reporting, but it's there in your SBR later on. So if you understand the concept of financial instruments very well in financial reporting, it will help you later on in SBR to catch on. By the way, I have finished IFRS 9 financial instruments for my SBR students, but it's not free on my YouTube channel. You will only get it if you become my ACCA special member, or for some countries where you cannot be a member, you have to purchase my SBR lectures. Now, let's start. So, first we are going to go through introduction of IFRS 9. First, we are going to go through the complexity of financial instruments, the relevant IFRS standards that deals with this, how do we apply it, and the scope of the standard. Then this standard is divided into three parts: presentation, disclosure, and the measurement recognition, and all those things. So for presentation, we have a separate standard, IS 32. But all the standards will be covered in this lecture only because they all deal with one thing: financial instrument. So here we are going to define what is financial instrument, financial liability versus equity instruments. Remember, financial instruments are same like what you have covered in all your previous lecture. What did you do? What are the 5 elements from your conceptual framework? Asset, liability, equity, income, expense. So we are focusing on asset and liability. Most of the standard, either they are an asset or they are a liability. Okay. So that's why same. The older thing is you just put the word financial in front of it. So in this, we are going to go through financial asset and financial liability. Okay, and also equity. So it is coming from your balance sheet, statement of financial position, the three components: asset, liability, equity. Okay, compound instruments. Compound instruments means an instrument which has the features of both liability and equity. Then treasury shares. Then offsetting your liability and asset. Then we are moving on to income and the expense part. Asset and liability, with that comes income and expense also. That's why interest, your dividend, your gain and losses. Okay, if you're having a financial liability, all liability, like any loan, if you have taken, you have to pay interest. Either you're receiving interest or you're paying interest. Okay, so either it's your income or an expense. Same for dividend. If you're having an equity shares, you're either receiving dividend or you have to pay dividend. And gain and losses due to changes in the fair value. Now, financial asset. So from here onwards, we are moving on to IFRS 9. So now we are shifting from IS 32 to IFRS 9. Mostly IS 32 is classifying financial liability and equity correctly. That is all about IS 32 in brief. Moving on to IFRS 9, which is a major standard. So first, financial asset. Like how we have started with property, plant and equipment asset. We started with initial recognition. Same here also, initial recognition. Then we'll move to initial measurement. Then comes subsequent measurement. Like any asset, you see, try to get that big picture. Try to go back and review. What have you done? We started with property, plant and equipment, intangible asset, all kind of assets. We first did initial recognition, then we did initial measurement, then we did subsequent measurement. Same standard, same way. Then presentation of income and expenses. Why income and expenses? If it's an asset for you, you are receiving income. But if you have given that asset to someone else, it's an expense for you. Moving on to impairment, like how any asset is impaired. Financial asset is also impaired. But one thing, you have to Be very clear is, if any other asset is impaired, for example, your property, plant and equipment, or your intangible asset, or your property asset, any asset, there is a separate standard that deals with it, which we have covered in financial reporting. That is impairment of asset, which is dealt under IAS 36. But for some assets, there are specific standard. For example, this one. If your financial asset is impaired, we do not go by cash generating unit, the CGU, comparing recoverable amount with the carrying amount. Like normally how we do for impairment under IAS 36. That we don't know. We follow the rule of IFRS 9 to impair the financial asset. Okay. So here we are going to go through the impairment loss model. Impairment of trade receivable. Remember, what is trade receivable? We didn't still go through the definition of all this financial asset and liability. But let me tell you in short, financial asset is anything that is giving you cash. In short, for now, just know this. And financial liability is anything that takes the cash out of your pocket. Mostly it's finance. It is something to do with cash. For example, your inventory, your non-current asset, all these are not financial assets. They're your physical assets. But your one example is trade receivable, your cash at bank, your trade receivable. Why you are going to receive cash from your customer? You will put cash in your pocket from your customer. That's why trade receivable is one kind of financial asset. So if trade receivable is impaired, how do we deal with it? Will be explained in this lecture. From financial asset, we'll move on to financial liability. Okay, same initial recognition, then measurement, then moving on to derecognition. Like how any asset, when there's a recognition, there's an opposite also, derecognition also. So derecognition of financial asset, derecognition of financial liability. Then we are moving on to the third standard. We have finished IAS 32, IFRS 9. Now IFRS 7 deals with disclosure part of financial instrument. So disclosure of asset liability, disclosure of gain loss. And finally, we are going to conclude with which part of the syllabus, how much of the syllabus we have covered by covering this lecture. Then we'll summarize the entire lecture. And are there any technical articles that you have to read specifically for financial instrument? We'll see at the end of this lecture. So this is a overview of what I've just gone through. So IAS 32, IFRS 9 deals with financial asset, then impairment of that asset, then financial liability, derecognition, and finally all this will be disclosed under IFRS 7. So as you can see, there are no other element that has so many standards like financial instruments does. Financial instrument is the only one which has 3 separate standards dealing with it. But if you see your property, plant and equipment only has IAS 16, your leases only has IFRS 16, your revenue only has IFRS 15, your investment property only has IAS 40, but financial instrument is the only one which has 3 separate standards. Why? The nature itself is very complex to deal. So that's why recognition and measurement is put in one category, presentation is put under separate standard, and disclosure is put under another standard. But all together, they perform together. Remember, they are not isolated. That's why they are dealt in this standard itself, this lecture itself. Okay, so now let's start. If you see reporting entities, they have always had basic financial instruments. Like all organization will have trade receivable, they will have trade payables also, because we are dealing with credit. Okay, which means companies are now entering into more complex transactions involving financial instruments. Earlier they were basic, now they are more complex instruments that they are taking. For example, now organizations are using derivatives either for speculation or hedging. Okay, let's say forward contract, options, all those things you must have covered in your financial management, right? But in this subject, that is financial reporting, we are not going to go through depth how forward contracts are dealt with, how do you hedge your risk using it. All those things are not, they are part of financial management that you must have covered in financial management, or you will be covering it in financial management if you have not taken AFM yet. But derivative is one kind of financial instrument. Why? Again, it has to deal with finance. Next, debt instruments. If you are having any debt instruments with complicated terms, why do we take debt instruments? Debt instruments are all your bonds, loans, mortgages. Why? To raise finance. Anything to raise finance is financial instrument. And when you invest in shares, why do you invest in shares? Again, finance. Okay. So these three things: derivatives, debt instruments, investment in shares, or we can say equity instruments. These are financial instruments. So because they are complex, that means you need specific IFRS to deal with it. Now, so let us go through the number of IFRS standard. First, IAS 32 that talks about presentation, IFRS 9, and then IFRS 7. First, we'll go through IAS 32, then IFRS 9, then 7. Now, all three standards you have to be applied. Okay. So IAS 32 answers your question: what type of financial instrument? Equity or debt? IFRS 9 will deal with, once you decide whether it's equity or debt, accordingly you will deal with it. IFRS 7 then will disclose it. Now, IAS 32. Let us start with the presentation part. Okay. So, you can present your financial instruments either as financial asset, financial liability, or equity. Okay. Remember, based on your classification only comes your measurement, recognition, and disclosure. If your classification goes wrong, that means presentation goes wrong, everything else will go wrong. That's why at this stage you have to be very careful. Okay. Now, not only that, not only financial asset, liability, equity, IAS 32 also gives you guidance on how to deal with interest, dividend, losses, gains. Now, IFRS 9. What is the scope of IFRS 9? Measurement, recognition of financial asset, liability, and equity. Okay. But remember, IFRS 9 does not give guidance on accounting for equity instruments. It is only for financial asset and liability. Okay. So you recognize either financial asset or liability, the initial measurement, subsequent measurement, and derecognition. These are the four areas. Then there are other issues, for example, hedge accounting. That is not in your financial reporting syllabus, but it is there in your SBR. Hedge accounting. Then IFRS 7 deals with disclosure. Okay. Now, let us start with IAS 32. Defining financial instrument. Financial instrument. Remember all these definitions and all, you don't actually have to memorize it, but understanding is the key. So any contract which gives rise to both a financial asset and a financial liability. Why both? See, for one entity is an asset, for another entity is a liability. Your asset is a liability for another one, and your liability is an asset for another entity. That's why it has to give rise both to a financial asset of one entity and a financial liability of another entity. Remember, it could be a financial liability or an equity instrument of another entity. Asset for you, liability could be a liability or an equity for another entity. Okay. Now, so from there, let's see what is financial asset. It's any asset which is cash. An equity instrument of another entity. What does it mean? Equity instrument means when you're having shares in another company. Why? Because you're going to get dividend. That means ultimately you are going to get cash only. That's why even equity instrument when you're having in another entity, that is also financial asset for you. You're going to receive something from it. Any contractual right to receive cash, for example, trade receivable, where you have the right to receive cash from your customer. Okay. Or if you have the right to receive dividend, that means right to receive another financial asset, that is also financial asset. Any contractual right to exchange your financial instrument with another entity under conditions that are favorable for you. Okay. So any of this condition, it's a financial asset. Now, a certain contracts which will be settled in the entity's own equity instrument. So any of these five are example of financial asset. If you are not understanding the last 2 points, I'm sure most of you did not understand point number 4 and 5. That is how favorable condition and own equity instrument. Don't worry, I will explain you this with a calculation, numbers, because I know students love numbers more than theory. So I will stop in point 1, 2, 3. If you understand that much, that is still enough, you can proceed with it. Point number 4 and 5, when I go through calculation, I will tell you what this point number 4 and 5, how it is dealt with. But for now, just remember, if it's a financial asset, favorable and settling in own equity instrument. Moving on to financial liability, opposite of financial asset. There you have the right to receive, here you have an obligation to pay. Okay, to pay what? Cash or another financial asset, or to exchange financial instruments, but conditions are unfavorable. This is the reason I've told you, remember, when it's an asset, conditions are favorable, but when it's a liability, conditions are unfavorable. And again, contracts settle in own equity instrument, that is same as financial asset. An equity instrument, in short, it is asset minus liability. Residual interest means whatever is left over after you deduct your liability from your asset is your equity instrument. Now, examples of financial instrument. So these three are the examples of financial instrument. For one entity, it's an asset. For another entity, could be financial liability or equity. So let's say company A is selling goods to company B on credit. So for company A, it's a financial asset because they are going to receive from company B. It's a trade receivable. But for company B, it's a financial liability. For them, they have to pay to A. So they are trade payable. Okay, the next scenario. This is the simple one, basic, everyone understands. Second, company A is issuing shares to B, issuing shares in B. So for company A, again, it's a financial asset because for them, it's equity share investment. But for B, it's an equity instrument, not a liability, equity instrument, the ordinary share capital. And A, third one, A is issuing loan stock to B. Who is issuing loan stock? A. That means A is having a financial liability. Loan stock for A. For B, it's a financial asset, debt investment. Why? B is the one who is taking that loan. They're receiving it. For them, it's a debt investment that they have taken. For A, it's a liability. Okay. Now, sometimes this distinction between financial liability and equity is not very clear. Okay. Not always. So IS 32 addresses this in detail in the next section. That is section 2.2. Now, primary and derivative instruments. As I told you, not only trade receivable. There are any complex instruments like derivative is one sort of financial instrument. So that also you have to explain. But there are two types of derivative, primary and secondary. All the examples of the financial instruments in the section above that you have just gone through are primary instruments. That means the trade receivable or equity shares or debt investment that you have gone through are primary instruments. In other words, a financial instrument whose price is based directly on its market value is a primary. Derivative are those which derive their value from the price or rate of an underlying item. For example, forward, option, swap, these all are derivatives. For example, if a company is entering into a forward to buy dollar for a fixed number of euro in the future, so the value of the forward depends on the actual exchange rate compared to the contracted exchange rate. You see? Now, accounting for derivative, remember this will not be asked in financial reporting. So you don't have to do any calculation. So thank God for it. Items that are not financial instruments. This is also very important. Many students understand what financial instruments are, but they don't understand what are not financial instruments and they accidentally put that in financial instruments. IS 32 is very clear about it. So all your inventories, plant, equipment, they are not financial instruments. All prepayment that will result in the receipt of good or service rather than receipt of cash or financial asset is not a financial instrument. Deferred income or contract liability that will result in the delivery of good and service. Main is you are delivering good or service, not cash. Then it is not a financial instrument. Income tax liability, because they are the result of statutory requirements, not contractual. They are not contractually obligated on you. They are based on the law. So that is income tax liability, also not financial instrument. Now, financial liability versus equity. So now you have to look at the substance of your contractual arrangement on the initial recognition, whether to classify it as liability or equity. Some instruments will take form of some financial instruments, their legal form is equity, but in substance they are liability. So you have to see the substance form, not the legal form. Legal they could be equity, legal form could be anything. Main is substance. If in substance they are liability, means they are liability. Okay. Why? Because there's a contractual obligation to deliver cash to another entity. Preference share. Most of the time, if you see your exam also, preference share, they often give you preference share, because preference share is one example which can be shown as equity also, liability also. Okay. So preference shares that require the issuer to deliver cash to the holder, either on redemption or in the form of dividend. If you are required to deliver cash, it is liability, even though legally they are equity. Now, example 1. So let us go through example 1, where we have two classes of preference share and we have to see whether they are equity or liability. So here it's about class A and class B preference share. For class A preference share, they are redeemable. They do not carry any mandatory dividend payment. But class B, they are irredeemable and they carry a mandatory annual dividend. So now the redeemable preference share, they are not equity. Why? They're financial liability, because you have an obligation to transfer cash. See, you have to make a mandatory dividend payment. Sorry, they do not carry a mandatory dividend payment. The redeemable, they are not classified as equity. As there's a contractual obligation, transfer to cash. See, if it's redeemable means there's a contractual obligation to transfer cash. Anything which is redeemable, you have a contractual obligation. Therefore, they are financial liability. This is one aspect, just by looking at the word redeemable. But there is another part to it also, that they do not carry mandatory dividend payment. So if the shares have been redeemable at the option of the issuer, you see, they told it is at the option of the holder. But if it is redeemable at the option of the issuer, they would not meet the definition of a financial liability, as there is no present obligation to transfer cash to the holder. However, when the issuer will exercise this option, an obligation will arise. You understand? So you have to see who has the option, the issuer. But here it is the holder who has the option. See, they are saying if the issuer has the option to redeem, then it would be equity. Then it would not meet the definition of financial liability. But here, the holder is having the option. That's why it is meeting the definition of financial liability. So based on both the two elements, it is meeting the definition of financial liability. Therefore, it's financial liability. Understand? The second part, the class B is irredeemable. They're classified as liability, because there's an obligation to transfer the cash, the mandatory dividend. There's a mandatory dividend attached to it, even if it's irredeemable. But if the shares had not carried that mandatory dividend, then they will be equity only. Because they had carried a mandatory annual dividend, they are liability, not equity. Now, compound instruments. Most of the time in IS 32, what is tested is compound instruments, where you have to separate the debt and the equity component. Okay? That means it has both the features of liability and equity in one component. One example, a very famous example of compound instrument is convertible debt, where you can convert your debt to equity or equity to debt. Okay? That gives holder the right, the option to either redeem the debt for cash or convert the debt into fixed number of equity shares. Okay? Even in SBR also, compound instruments are there. Okay? So now, such compound instrument is giving a challenge. Why? because the issuer cannot know whether the holder will choose to receive cash or shares. So IS 32, what do? You have to do split accounting. Okay, you have to recognize both debt and equity. That means you have to recognize the financial liability as well as equity. Now, obligation to repay the debt, financial liability, and the option to convert is equity. Financial instrument that has both equity and liability, you have to classify into separate component. But always you have to start with the liability component first, because remember the residue is the equity component, the balancing part is equity component. This will do with numbers, of course, do not worry. So how do you initially measure component instrument? First, you will measure the liability component. First, you will be given the discounting factor. Using that discounting factor, you will find out the liability component, where you will discount the future cash outflow. Cash flow, okay, on the assumption that it will be redeemed for cash. So it can be redeemed for shares also, but we are assuming it will be redeemed for cash. Okay. Remember, the discount rate that you have to take is the market rate for a similar liability without that conversion option, because you have the conversion option. But when you are taking the discount rate, you have to choose a similar rate without that option. This will be given to you in the exam, so you do not worry. You don't have to calculate all the discount rate and all. Just it will be given to you. Maybe they will give you two rates. You have to know which rate to take. That is the rate without the conversion option. Example 2. Very good example. If you understand this, you have understood. I used to do completely. But of course, it is not just one question. We are going to do multiple questions. Okay. So it's about Ovido issuing 10 million 5% convertible loan note. And on 31st December, they will either be repaid at par or converted into shares. Interest rate to convert without the option to convert is 8%. This is the discount rate I've been talking about. See, they have given you two discount rates at 5% and 8%. This is why you have to understand which rate to take. Do you have to take 8% or 5% as a discount factor? 8%, not the 5%. This 5% is to find out the interest on that loan. This 8% is the discount rate, without the option to convert. Okay. So now let us do this in Excel. So now we are going to start with, remember, there's a pro forma to this. You have to follow the column format. Okay. So since there are 3 years, first we'll start with the year. Okay. We'll start with year 1, 2, 3. You have to press twice, because remember, for the first 3 years, we'll be receiving interest on that loan, and the third year also the principal amount. Okay. Then there is a payment. Okay. Remember, we are working on the liability part first. So we have to know how much interest, and with the principal amount, how much we have to pay. The interest and this one. And because the equity part will be dealt later on. This is a compound instrument. We are separating the liability and equity component. Okay. So then we have the discount factor. As I told you, it's at 8% without the option to convert. And then the present value. So this is the way you have to do. Always remember, whenever compound instrument is given, write the years like this, payment or receipt, depending on whether you are investing it, or you are giving it to someone, or you're taking it from someone, depending on that. If you're taking the loan from someone, you have to pay, because you have to make the interest. But if you're giving the loan to someone, you are receiving. So it's a receipt for you in that case. Then discount factor, like it's given here, and the present value. It's always. This is never going to change. The standard is this only, even in SVR. So just go up and check the amount. It is a 10 million loan with 5% convertible loan notes. So 10 million means your principal amount will be 10 million, but your interest will be 5% on that 10 million, which is 500,000. So let's $10 million, right? So it is 5% on 10 million. your interest. 1, 2, 3, 2, 3. 6 zeros after 10. That means total 7 zeros. So 500,000. Okay. This is one way of dealing with it. There is another way of dealing with it. That is if you want to drop down the zeros. If you want to drop down the 3 zeros, last 3 digits, that also you can do. So this 500,000, then it will be only 500. That is also a way of dealing with it. But let's assume you want to go like this. So it's 500, 500, 500,000 each time. And here when you move with the 500, you'll be having 10 million. So it's 10,500,000. 10,500,000. That means with 10 million, you'll be adding 500,000. Okay. Sorry, this is year 3. You have already taken 500. So here it will be just 10 million. The principal amount. Okay. Then the discount factor, 8%. So they have already given you the table. You just have to copy paste it from here. You see 0.926, 0.857, 0.794. So 0.926, 0.857, 0.794. Remember, when you take here also you have to take the same because both are the same year. Okay. So now when you find the present value, just simply multiply this by this. Once you do it in one cell, no need to do it in another cell. Just copy paste in your other cells. That's it. Okay. So what's happening here? You see, this is the total 794,000, 7.94 million. So now you have to do the total sum of all this 4. This is the total 922 922 Okay. Now there is another way of working this out. This is shortcut if you want. I'm just showing you. Again, it's up to you whichever method you want to use. But in your exam condition, it makes sense that you know the shortcut as well. Because sometimes you will not be given the full time to do. Okay. Just apply the cumulative discount factor. Okay. Cumulative discount means, see, all these 3, they have the same cash flow. So just add all these 3. Okay. And see. So it's this, just put comma, and this. Basically, you are doing what? You are finding the annuity factor. So annuity factor is 2.577. So you multiply this with 500,000. Okay. It is this, isn't it? Now, with this, you'll be adding this amount. So it is this separately you have to work out, by the way. See, it's the same thing. This and this 2 are the same. The older thing is, what are you doing is you are just adding this 3 discount factor and multiplying it with 500,000 rather than showing it separately like this. Whichever method you feel is convenient for you, you can do it. But the result will be same. So now, this is your liability component. Financial liability is this only. That's it. Equity, how will you find out? The residue. What is your amount that you're issuing? 10 million. 10 million. So from 10 million, just deduct this. That's it. That is your equity component. So this is your equity, the residue, and this is your liability. That's why I always tell you equity is the residual balance. If you get your liability correct, your equity will be correct because that's just the residue. So it is 771,500. But if you see the answers given in the book, it is given as 771,000. That's fine. They have rounded up this figure and they have got. They have used it. They have used a rounded figure. That's why. It doesn't matter as long as you understood the technique. Okay, so now understand the entries also. How do you do the journal entry? How much you're doing? So you debit your cash 10 million, debit cash 10 million, I'm writing 10M. And where do you credit? Equity. Both equity will be credited and liability will be credited. Remember, it has to add up to your debit side, that is 10 million. So it is simply this amount and this amount that you credit. That's it. Right? Now, check. There is another table that you have to do. That is, you have to check at 31st December, at the end of the 3 years, you have to be able to recover this 10 million. This is for 3 years. You see, on 1st of January 2001 to 31st December 2003. So what will I do? I will just copy paste this here. Okay. So you see, this is the balance you have got for your liability. So for 1st Jan, this will change to, now you know your balance at 1st Jan. This is your liability. So for 3 years you have to discount and you have to basically check your closing liability balance after 3 years. And interest, you will be using 80% interest only. Interest at 8%, you have to find interest on this balance now. Now no longer discount, now this becomes your interest rate on your liability, on your loan. And then interest that you have paid, that is this 500,000, you'll be deducting it. And finally the balance at 31st December. These are the two tables you have to do because we want to find out at the end. See, there is a way of checking. There is a sure way of checking whether this amount is correct or not. That is, at the end, after 3 years, 31st December, at the end, you should be able to get the exact 10 million amount, the amount that you have started with. If you get that amount, be very confident that your amount is correct. I will show you how. So here, it is this amount, 9228500. This is the amount of your liability now on this date. Because now you know your liability clearly, which will be repaying at the 3 years. So now you will find the interest at 8% on this amount. And then you will be deducting 500,000 minus 500,000 interest paid. And your balance will be just the sum. Do not put minus because already minus. Just put the sum function and this take this. That's it. That's it. This balance you will carry forward here. So just copy it here. Paste. It will not paste it. Why? There's a formula attached to this. So when you're copying it here, when you paste it, make sure that you take the value of with the formula. I will take the value. So just I will take it down. Automatically they will take 8% on this, and here you have to deduct 500,000. And just I will take it down. Remember, avoid decimal. Whenever you are given decimal, take it as a whole number. So here I can see a decimal. I will automatically take out that decimal. Then here again I will take end of third year, paste the value. I will drop down the decimal. Done. 777 90 100. Again 500,000. For 3 years, I'll be doing like this. Why is this? It has to be 100 million. You see, there is a discrepancy somewhere. That is because I've dropped down the decimal. So they have taken rounded figure. Okay. Okay. So if you take exact number, this one, let's go by the exact figure without dropping down the decimal. You say it's 1 million, but there's a discrepancy somewhere. It has to be 1 million only. Sorry, 10 million. Exact amount. Yeah, few differences could come. That is due to rounding figure, but mostly it has to be 10. Okay. So this is the issue when you deal with huge numbers like this. So that's why in the answer, if you see, they have avoided the 3 zeros and then they have dealt with a smaller number. Here they have shown. So just let me take you through the answer. So this is example 2 solution. I've told you they have dropped down the zeros like this. You see, we have dealt with the whole number. That's why it's often difficult. It makes it very difficult to deal with huge numbers, right? So it's easier to deal with small number. So that's why often you see the answers, they will drop down the 3 zeros. So I would also suggest that this is most of the easiest and the wisest way to handle questions where you have big numbers like millions and all, trillions, millions, right? So you see, they have taken 500 for 3 years, then 10 million, discount factor is 8% because this is the rate without the conversion, got the present value, and we have got some 922 8500. They have rounded up that 8500 to 9. Okay. The alternate ways also they have shown you where they have added this 3 discount factor and got the annuity factor 2.577 multiplied with 500 and added with 7940 and got the same amount like this 922 999. Then this they have deducted from 10 million and got the equity amount. Then they have shown you the journal entry where cash is debit and equity liability are credit. Both are balancing with 10. Now remember the equity amount remains fixed until conversion. So you don't have to worry about equity. Until conversion, equity will be equity only. But the liability will be acquiring interest on it. And that interest will be the same rate that you have used to discount. That is 8%. So you will recognize it as an interest expense in your statement of profit and loss. That interest. And the interest that you have paid out will increase the carrying amount of a liability component. Sorry, and the remainder will increase your carrying amount of the liability. So that at the redemption date, it will be equal to the amount payable. That means amount to the 10 million. Should holders choose to redeem for cash? If you are choosing to redeem for cash, see, we don't know whether we are choosing to redeem the debt for cash or for equity. But if it's for equity, see, that's why for equity component, it's same until conversion, no worry. But if you want to convert the debt into cash, you have to know the amount. That's why we have done this table. The second table is for that. This also you have to know always. After this first table, where you have got the liability component, to get the equity, you have to do this also. You have to know at the closing what is the amount. When you redeem for cash, what would be the amount? It would be the same amount that you started with 10 million. So this is the amount of liability that you have gone. It will interest will be added to it, that 8% that will be used as a discount factor. the amount that you have paid 500. So closing balance, you will take again as opening, add 8 minus 500, keep on doing it for all the 3 years until you get this. See, we have got some 10 million something, 2000 something, right, at the end. That's the reason we have got it, is because we have, they have taken the rounded figure. Okay, but ultimately you should be able to get 10 million only, even with the accurate figures. But you see, they have dropped down the 3 zeros in all the figure, and they have dealt with dropping the zeros. Okay, so the principle is this: you should be able to get the same figure. Even here also, if you see the interest, they have rounded up and down. So if you get slightly a figure different to this, but still show it as 10 million only. Okay, you might get a different figure, slightly up and down than 10 million, doesn't matter. You'll be given the full marks if you have a number closer to all this. This is fixed 500, but interest and the balance, if you have a little bit here and there, doesn't matter. You'll be given the full marks. Make sure that this you will show 10 million only. You'll show it as 10 million, even if you are getting a different figure. Okay. So what does this mean? At the end of 3 years, you are going to repay this 10 million, or it will be converted into shares. If the holder chooses to convert their loan into shares, this liability balance will be transferred to share capital. But if they choose to redeem their loan notes for cash, if they are choosing from loan to cash, now they no longer have loan, it will be redeemed to cash, means liability will be discharged. So in either case, your initial equity balance of 771, this will be there in your equity. This will not change. This 771 is this amount. This amount. You see? This is the amount that you have gotten for your equity. Even after conversion also, this will remain same. But your liability will be discharged if you are converting debt to this one. But if you are converting debt to equity, it is 771,000. Now, activity 1. Again, an example of convertible debt. Again, we'll do this. So this is about 2000 convertible bond, 2000 convertible 1000 bonds. They are issuing 2000 convertible $1,000 bonds. So in short, they are saying it's a 2 million bond. Multiply 2000 with 1000. There are 2000 shares. Total number of bond is 2000. Value for each bond is 1000. So 2000 into 1000, 2 million bonds. Okay. Interest is 6%. Market rate of interest at the date of issue was 9%. Remember, this 6% is there on this loan, and this 9% is the discount factor. Bond is redeemable on 31st December 2009, and you are issuing 2007. That means after 3 years, 2007, 8, 9. So calculate the amount of bond to be included in financial statement on initial recognition and the first year of issue. So let us do this in Excel. So now, here we don't have to do the same thing that we have done for example 2. That is drawing up the 3 columns. Why? Because here they just told you to calculate the amount at which bond will be included in the financial statements on initial recognition and for the first year of issue. Okay. So now, first let us find out the present value. You can do this in one line. Find out the present value of the principal that will be repayable. Remember the principal amount, 2000 into 1000 is 2 million. Right? So principal amount is 2 million. So since the principal amount is 2 million, remember the discount factor I've just told you you'll be using is 9%, not 6%. 6% is the interest that you are going to pay. So you have to take for the third year, because principal amount you will pay at third year, that is 0.772. But when you are using the interest, that is 6% on 2 million is 120,000. That you have to add up the 3 cumulative figure and find out. But since we have this table, I can take an advantage of this is I can just change the figure and put it here. What can I do? So just put this as 6% and this as rather than 10 million, it is 2 million. You see, automatically it is 120,000. So this 3 also is the same. And here, just change the 10 to 2 million. And rather than 8, it is 9% discount factor. So here, I'll be having 0.917, 0.917. Then we have 0.842. You can just add the 3 discount factor, find the cumulative and multiply it with 120 in one line, or let 0.7. This also 72. So what is the amount that you are getting? 184,720, right? This is the amount of your liability. So your equity component will be just simply this minus this. It is this. 152,280 is your equity component. Now, they told you what will be recognized during the first year. That means first year means this year. This they are asking, this one line. So here we'll put the balance. It is simply this amount that we'll copy paste here. And here it is 9% on this amount. And the interest paid would be 120,000. So here we'll drop down the zeros. It is this amount, 1894015. This is the amount, that's it. Okay. Just let me do for 3 years and see. This. So you see here, I was testing what I've just told you, that this is almost near to 2 million. If you see all this rounding figure, that's where it's different. Okay. We just drop down this. Okay. So this is the solution for activity 1, where on initial recognition, we have to find the present value of both the interest income as well as the principal amount. So the principal amount was 2 million, and using the 9% discount rate in year 3, this was the present value. And for the interest, since you'll be getting for the 3 consecutive years, you have to add all the 3 discount factor at 9%, which is 2.531 at 120,000, because the interest, that is 6% of 2 million, is 120. When you add them together, this was the total liability component that we have got. This you have to deduct from 2 million, then you will get your equity component also. Now they asked the question that what is the year-end liability solely for 1 year. So initial liability is 1847720. With that you will add 9% interest. Remember, now it's not 6%. Now the interest expense that will go to PNL is 9%. Why? See, this is the discount factor without conversion. You understand? So now you don't have to convert this any longer. You have already converted it. You have used 9% to discount. Now we are going to find 9% to find the interest expense. And then 120 interest that you have paid, you will deduct. And this will be your year-end liability. Because any interest will be added with the liability. See, any interest will be added with your loan liability. You pay the principal as well as the interest. Also, the amount that you have paid, that is the cash interest paid, you will deduct. So year-end liability. Okay. Now, exam advice. So your annuity factor is simply the sum of the three discount factor. Okay. You will not have to calculate the cumulative discount factor in the examination. However, you may be required to calculate and apply a discount factor for 1 year. Okay. So liability at the end of year 3 will be 2 million. The standard is silent on what to do with the equity component. An option would be to transfer it to retained earnings over the life of the instrument. So if the standard is silent means they will not going to test you that what would be the amount at the year end of the equity. That they will never ask you. They might ask for the liability like this, but not equity because the standard is silent. Okay. Now moving on to transaction cost that are related to compound instrument. Any instruments will have transaction cost also. If you take a loan, if you issue shares, there are some cost to it. Same for compound instrument also, there are some transaction costs. What do you do with it? This transaction cost you have to allocate for equity and liability component in relation to their proportion, okay, to the proceed of each component. So the transaction cost that are going to the liability element will reduce the initial measurement of liability. See, that means when you measure liability from your initial measurement of liability, this transaction cost needs to be deducted, and also from equity element you will deduct the transaction cost. In short, doesn't matter whether it's a liability element or equity element, transaction costs are always deducted. Okay. How do you deduct from equity? You deduct from share premium or retained earnings the transaction cost. So that means transaction cost is also an expense in your profit and loss. That's what. Now, treasury shares. Entity may reacquire its own shares. They might cancel or they might reissue them. So the amount that are paid for the share will be presented in your statement of financial position as a deduction from equity. There are no gain and no loss on this transaction. Okay. Now, offset. Financial asset and financial liability normally we present separately. But IS 32 says that under certain circumstances, you can offset financial asset and liability. That means you deduct the liability from the financial asset and show the net financial asset or net financial liability. Okay. Two conditions. One, entity has the legal right to offset and they intend to settle on a net basis. That means they are realizing the asset and they are settling the liability simultaneously. It's an and condition, and means both has to be satisfied. One, legal right has to be there to offset. Number two, liability and asset simultaneously they are doing it, settling. So if this is so in the exam, they will tell you whether there's a legal right or not, whether they are settling the asset and liability simultaneously or not. If the question does not say anything about the legal right or settling on net basis, assume you can't offset and you will show financial asset and financial liability separately. That's like the default position, the norm. Normally we present separately only. I've not seen any question where they have told that you can offset. But let's say, assume in your case, for March 2026, they say that there is a legal right, they are settling on net basis, then you can offset. Now, so an offset might be made between trade receivables and payables also. Remember, trade receivable and payable is also one kind of financial instrument, right? That also you can offset. But remember, with the same counterparty or accounts in the debit and credited bank. It has to be with the same counterparty or thus. Now, moving on to the income and expense part. All this while we have been talking about asset and liability, interest, dividend, gain and loss. So all this, whether it's in interest, dividend, gain and loss, these are related to the financial instrument. You have to present according to the classification of the item to which they relate. Therefore, if there are any dividends that are paid in relation to shares that are classified as equity instrument, remember shares can be your financial asset also. Shares can be your equity instrument also. But if your shares are presented as equity instrument, then the dividends that you have to pay regarding for those shares, you will present as you will show them in the statement of changes in equity as a deduction from your retained earnings because you are paying the dividends. And if dividends are paid in relation to the shares that are classified as financial liability, see, one example is preference share. Preference share, even if it's shares, if they are classified as liability, any dividends that you have to pay, you will present in the financing category in your statement of profit and loss as an interest expense. Did you see the treatment, how it differs? Just changing the classification from equity to financial liability. Same dividend. Earlier, you deduct from equity in the statement of changes in equity. Now you totally bring it into a new statement, that is statement of profit and loss under financing category. Okay. Remember, in short, if you see most of the income, dividend and interest that has to do with financial instrument, if you see, most of them falls in the financing category only. Because normally we do financial instrument, we carry for financing purpose, right? To finance. We do not use it for our operating purpose for day to day. We don't use financial instruments normally. Unless your business is such that you are dealing with financial instruments, then it will come in the operating category. But it is, let's not make things very confusing. So you can go by the financing category. It's an interest expense. Why interest expense? Because the shares are classified as financial liability. So anything to do with financial liability means interest. Then you can't deduct dividends normally how you deduct if it was equity. Okay. Now, IFRS 9 gives guidance on accounting for transaction costs that are related to financial liability. So IS 32 requires transaction costs that are attributed to the issue of equity instruments you deduct from equity. See, there are two standards. If your transaction cost is relating to financial liability, IFRS 9 will give you the guidance. If it is transaction cost from equity instrument, IS 32. IS 32 says deduct from equity. IFRS 9 also says deduct from financial liability, the transaction cost. Now, let's move on to IFRS 9 in depth. Financial asset. Initial recognition. So this is a financial asset. Where do you recognize asset? In the statement of financial position. Same. Where entity becomes a party to the contractual provision of the instrument. Financial asset is classified on initial recognition as one of this. Either you recognize it at fair value through profit and loss, or fair value through other comprehensive income, or amortized cost. This is a must. You need to remember the difference between this three and under which condition you have to put it under first, second, or third. Very important. This will be tested. This is what is tested. And this is the area where students often struggle. This is a critical area. If you go wrong here, if you do not understand this part, you will not understand anything at all. You will not understand subsequent measurement. You will not understand impairment of financial asset. You will not understand derecognition. You will not understand financial liability, equity, nothing. This is the first step. So I'm going to go a little bit slower here because this is again going to be repeated in SBR also. Okay. Now, what does fair value to profit and loss, fair value to OCI, and amortized cost means? Fair value through profit and loss. See, the first two, let me explain you the first two. First two means you will recognize financial asset at fair value only. They will give you in the question what is the fair value. Okay, normally. See, let's compare this with IS 16. Why IS 16? IS 16 is the basic, it is the easiest standard when it comes to asset. Remember, for non-current asset, our first standard was IS 16. That is property, plant, and equipment. There, they told initial recognition. You can initially measure financial asset either at cost. Initial recognition is at cost only. But subsequent measurement, you have a choice, cost model or fair value model. Here they are saying initial recognition itself. Here also there are two models, cost model, fair value model. The only thing is the name is changed. The cost model is only one, that is amortized cost. And the fair value, there are two, either through profit and loss, either through OCI. Remember, this is financial instrument. Financial instrument, since it's complicated in nature, even its measurement, its recognition also will be different compared to other standards, which are very easy. Most of the standards of non-current asset, if you see, whether in investment, property, or intangible asset, or assets held for sale, mostly fair value or cost model. But that comes later. Initial recognition, mostly it is cost. This standard, initial recognition itself, they are saying fair value or cost model. They are not saying only cost. So that leaves amortized cost out. It's a cost model. Amortized cost, you have to work out. Okay. We'll leave that for side. Now let us go through fair value through OCI and profit and loss. If it is fair value through profit and loss, any income and expense relating to that financial asset will be recognized in profit and loss. If it is fair value through OCI, any income and expense relating to that financial asset will be recognized in OCI. Now do you understand? This is what they wanted to see. The same principle goes for financial liability also. Okay? Okay. So now let us move on to the classification. When you choose out of this three, which one? There are two characteristics, and often in your exam, this is what you have to see. These two things you have to see. Both you have to consider. Not only here, even in SBR, it will be tested. First, what is the entity's business model? That means, are they intending to collect cash flow? Contractual cash flow. Contractual means, are they only collecting interest and the principal amount? Or they are collecting cash flow and they are selling the financial asset later on. See, one business model is you are holding it till the maturity date. Let's say you are giving a loan to someone. If you are giving a loan to someone, it's a financial asset for you. You are going to get interest on that. It's an interest income you're going to receive. So, or a bond for that sake. Okay, any debt you're keeping till the end. Let's say 3 years is your debt. You are keeping it till 3 years without selling that to anyone. And you are receiving principal and interest. That's one kind of business model. Next business model is you are selling. You are selling it also. You are selling the financial asset. So you're not keeping it till the maturity date. So when you are selling it, the rule is different. You will measure it by different method. And if you're not selling it, if you're keeping till maturity, the measurement is different. That's why this business model test is very important. It's a key. And contractual cash flow test. Two things. Are you keeping till the maturity? And the contractual cash flow characteristics. Now, classification is explained in more detail in section 3.3. Now, initial measurement. Okay, so on initial measurement, except trade receivable. Why did we say except trade receivable? See, or even trade receivable is one kind of financial asset, but except that financial asset, all other financial assets are measured at fair value. Initial recognition. Best evidence of this is normally the transaction price. We look at the transaction price on what we are transacting the instrument. That itself is the fair value. Transaction cost you can incur when you are acquiring the financial asset. Like transaction cost you can incur for any other asset also. So transaction cost, okay, this is the cost which are directly you are incurring it due to that acquisition of financial asset. Otherwise you would have not incurred. Okay, so this cost you have to take into consideration. Okay, example, any agent's fees or commissions are one sort of transaction cost. This you can't ignore. Now, if see, when we talk about transaction cost, remember the first three measurement, either at profit and loss, OCI, or amortized cost. If you're measuring your financial asset at amortized cost or OCI, that is fair value through OCI, transaction costs are added to this initial measurement. That means whatever is your financial asset, to that you will add the transaction cost also. If your financial asset is at amortized cost or OCI. But if financial asset is through profit and loss, any transaction cost you are recognized in your statement of profit and loss under investing category. Okay, because normally financial asset you keep it for investing purpose, for your investment, as an investment you want to receive. Okay, now trade receivable, which do not include a significant financing component, are measured at their transaction cost in accordance with IFRS 15. See, trade receivable comes under IFRS 15. Okay, that is when we recognize revenue. The amount of consideration expected in exchange for the transfer of promised good and service to a customer. What does this mean? See, this means for the amount of good and services that you have paid, that you have transferred, the amount that you are entitled, you are expecting to receive because you have transferred a good and service. So whatever, you will measure that trade receivable at their transaction price. Okay, that what is the meaning of significant financing component? Significant financing component means you have received an amount in advance. That means you have received the amount, but you have not paid your customer. You have not delivered the promised good and service to your customer yet. But before you delivering good and service, you have received the payment from the customer. So it's like a loan for you. It's like a debt. You have to repay it back. You have to pay it back. You can't recognize revenue until you have not transferred your good and service. So the amount that you have received in advance from your customer for the good and service that you have not given, it's a debt against you. It's you are liable to pay it back. Like how when we take a loan, it's a financing component. Same way, this is also treated as a loan. That's why it is said as when you are receiving anything in advance, that means you have received the cash amount but you have not transferred good and service. Then it is known as that you have. It's like you have taken a loan which you have to pay back until you don't deliver good and service. But if you have delivered good and service later on, you don't have to pay back. But until you don't, you will keep on recognizing it as a significant financing component. That is the meaning of significant financing component. That means anything you received in advance, not you have not paid. That is something different. Here we are talking about not the prepayment. Normally, you have delivered the good and service, then you have received an amount, or you are expected to receive an amount. That amount you will recognize your trade receivable at that amount only. That is the meaning of transaction price. Now, example 3. So in example 3, let's see what's happening here. Entity has purchased a financial asset for 1000 and they are classifying it at OCI. Transaction cost is 20. So this transaction cost also you will add with this purchase amount, which makes your asset initially 1020. Okay. If asset was amortized cost, if asset was classified at amortized cost, still it would be 1020 only. Asset would be measured at this way. But if your asset is classified at PNL, then your asset would be 1000, but this 20 you will recognize as an expense in PNL immediately. Okay, do not ask me why, ma'am, why, if they have done it like this for PNL, why not they have recognized asset at 1020, they have put in OCI. Why they have just simply added 20 with 1000 and shown the asset like that when it was at OCI? Do not ask me that question. Why? We don't know why they have done it, but this is a rule. Rule means rule, and you need to know it. So behind everything, you might not be able to get the logic. If you're not able to get the logic, doesn't matter as long as you understand what you need to do. So if it is at OCI or amortized, you will simply add that transaction cost with the asset amount and show your asset at that amount. Only if it is through profit and loss, your transaction costs will be expensed in the P&L and asset will remain at 1000 only. That is the only difference. Okay. Now, subsequent measurement. So initial measurement we have finished. After subsequent measurement, again financial asset you will measure based on the classification at either amortized, OCI or P&L. Now, let's start with amortized cost. Financial asset is subsequently measured at amortized cost if two conditions are met. First, you are holding your business model is you are holding the financial asset to collect the contractual cash flow. Then you are receiving only the interest and the principal amount. On specified date, you are going to receive a cash flow, and that cash flow is solely principal and interest amount. Okay. In short, what does it mean? See, before I move on, in short, what does it? In short, it means any debt in instrument can come under amortized cost, can be measured at amortized cost. Any debt instrument that is your financial asset. Debt instrument, financial asset means you are giving a loan to someone or you are giving a bond to someone. For that someone, they are taking a loan from you. For them, it's a financial liability. For you, it's an asset because you are going to receive the interest from them. So that's a debt investment. For you, it's an investment on debt. For you, it's a financial asset. So you are going to receive principal and interest. So that's why any debt investment, you can measure at amortized cost, but equity investment you cannot measure at amortized cost, never, because the condition, it does not meet the condition. For equity investment we do not recognize only we do not receive or pay only principal and interest. That is only on debt investment. Okay. And also one more condition, you have to keep your debt instruments for the long term until maturity. Then it is amortized cost. That means you have to keep your financial asset till the end. If you're giving a debt investment for 5 years, till 5 years you have to hold it, and you are receiving principal and interest for those 5 years on that amount. The effective interest method is applied to measure a financial asset at amortized cost and to allocate interest. Remember, your interest could be income or an expense, okay, in profit. Now, definition. So the amortized cost of financial asset or financial liability, even financial liability could be measured at amortized cost, which we'll cover later once we finish with the financial asset. Okay. So amount at which initially it is recognized minus your principal repayment. Remember, when you are doing making a repayment, of course from the amount that you have to pay, repayment are deducted, and plus or minus the cumulative amortization, that is using the effective interest method of any difference between your initial amount and the maturity amount. And for financial asset, this is only for financial asset, not for financial liability. You have to adjust for any loss allowance. Same how we have bad days and we adjust for our trade receivable. Here also for financial asset, we adjust for loss allowance, because financial asset, like any asset, even that can be impaired. Okay. So for amortized cost, this is how we work out. Of course, with calculations, you will understand this better. So example 4 is a good example to understand the scenario better. Now, here, Atkin has purchased 100,000 loan notes at a discount of 10% and classified them at amortized cost. They are paying annual interest at 5%, this instrument, okay, and it is redeemable for 103,000 after 5 years. Effective interest rate is 8%. See, it's very easy for students to get confused at this stage because there are three rates given. What is this discount 10%? What is this 5%? And what is this 8%? Okay, so I will take you through a question to understand this better and what rate to take at what time. And Atkin should initially measure their loan note at the proceed that they have received. Remember, the loan note is 100,000 but it is at 10% discount. That means at 90% you have to take. So the proceed, you will measure your loan note at 90,000. Okay. Now, there are three things. First, for the 5 years, let's find out the interest. First part is the 5 years interest. So loan is 100,000 into 5 years. What is the discount rate that you have to use for interest? 5%. Clearly they have told this is the interest. This is the amount at which they are going to pay annual interest. The word annual interest means for the 5 years, this is the interest. But if you see the word, this is discount of 10%, this is effective interest rate. You do not use these two rates to find the interest. It is only the annual interest. So since this is 5 years, over 5 years. So 5% into 100 into 5 years. Remember, when you're taking 5%, it is not on 90,000, not after the discount. It's on 100,000 loan note only. Yes, the amount that you are receiving is at discount because you have purchased it at discount. So this is the proceed that you are receiving. But the interest will be on the 100,000, not on 10%, not on discounted amount. Very important. Okay. Then the loan notes are redeemable for 13,000 more than the initial measurement. Initially they are measured at 100. Sorry, the discount. You have to take the discounted figure. It's 90. But it is redeemable for after 5 years at 103. So the difference 90 and 103 is 13,000. Loan notes are redeemable for 13,000 more. You don't compare 100 and 103. You compare with 90. Okay. So now what do you have to write? See, you have purchased the loan note. You have purchased a loan note means you will be giving this loan to someone else. After you purchase it, you are going to give this loan to someone else. It's an investment for you. You are going to receive interest on that. So it's an interest income for you. You understand? So how much interest income you will receive, which will go in profit and loss? This is allocated using the effective interest method. Okay. If you see how much interest for the 5 years is 25,000. See, this instrument is paying you annual interest at 5%. When you are giving this 100,000 loan to someone, okay, you are issuing it, you are going to get 5% interest on that amount. So 25,000 you're receiving, 25,000 interest receivable, plus the 13,000 winding up, this 13,000. Why? Because this is at 90,000, but you're redeeming it at 403 after 5 years. You're receiving more, 13,000 more. So 25 plus 13. So total 38,000 you will receive as an interest income from this loan note. Okay. Now let us solve this question using Excel. This is the solution, but we'll come once more. We'll come back to the solution after we solve our Excel. Okay, there is another way of getting that 38,000. Here you have got 38,000 like this. We got 25 and 13. There is another way of getting that 38,000. So now we will be allocating the interest income over the 5 years using the effective interest method. So this is how we are going to do it. We'll just change this previous question. We'll just change the figure. Here we are going to put all the years from 1 to 5. Then we'll start with the brought forward balance. Okay. This is the brought forward balance. And then we have the interest income here. And then we have the interest receivable. And then we have the carried forward balance. Remember, we start with the discounted amount, that is 90,000, not 100. So we'll drop the zeros and we are going to deal with only the figure. So for example, if it's 90,000, we are going to write 90. Okay. Wait. Let's take this figure. I have to format it to text. Okay. Now, dollar. The reason I've done it, because if I don't do it, the minute you put dollar 3 zeros, they will only show you 0. Try it yourself and see. That's why I had to format the cell to text. Okay. This means I'm dropping the 3 zeros. It's always advisable to do in the manner given in your answer, because then you have to deal with smaller number, stress is less, and it will be easier also. Okay. So for example, here if it's 90,000, I would just write 90. Okay. But when we are reading it, you will not read it as 90, you will read it as 90,000. Okay. It is denoted as 90,000. Now, interest income. Remember, interest income is on the effective interest rate, that is 8%. Okay. So when you're taking this one, it will be at 8%. So here you will take it at 8% into 90, 7.2. Then interest receivable is at 5%, 5% on 100,000, which is 5. But we are not going to write direct 5 like that. We are going to put 100 into 5%, 5. And this is a negative figure. You can't add two things. This is the amount that you will get. You will add with 90, and this is the amount that you will pay. So you will deduct 5. to get your carrying forward balance. So now you just have to use sum function once and automatically it's done. Now this I will bring it forward to the next year, the value, and then we'll take like this. Okay, so it will not take. I have to take 8% of this figure. Remember, since I have taken it to one decimal place here also I'm going to take it to one decimal place. Okay, and here it's always minus 5. For all the 5 years it's minus 5. Since I've already done the sum function, automatically I can do it here. I will only keep it to one decimal place. Okay, so this 94.6 closing balance will become my opening balance for the next year, third year, 94.6. And on this 94.6, 8%. 97.2. Now, fourth year, 97.2. You see? Now what's happening? Now when I take down, click here and check. It's already taking 8% of 97.2. But here, I forgot to take it to one decimal place. Okay? It's 100. And now, this 100 I'll put here. Okay? And all I have to do is I just have to drag it down. So automatically they will take 8% of 100, which is this. And this, you see, this was I was trying to say. This 103,000. The exact amount that you have just got here. It is redeemable for 103 after 5 years. You understand? And when you add all this, when you do the sum function here, the effective interest, just round it up. It's 38. Round it up to whole number. It's 38. Isn't it? So now in year 1, what's happening? You will recognize this 7.2. That is 7,200 as an interest income in your investing category, in your statement of profit and loss. And financial asset will have the carrying amount of this 92,200. And assuming that it is received as due, the 5,000 is an investing cash inflow. This is the cash that is going out. This 5,000 is an investing cash inflow. Inflow is coming into you in your statement of cash flow. Now, if there was a transaction cost, let's say of 5,000, this transaction cost will be added to your initial 90,000. This 90,000, that 5,000 will be added. Why? This is they are using amortized cost. Remember, for amortized and OCI, you add with your asset value the transaction cost. Only when it's through P&L, it will go as an expense in P&L, the transaction cost. So then your asset will become 95,000. Okay. So now that's it for this question. So this is the solution for example 4. As you can see, when you add up the interest income, which is the effective rate, it is 38. Where we have earlier also got 38,000. So this 7,200 is interest income, which will go in the investing category in your statement of profit and loss. Your financial asset will be carried at 92.2, and this 5,000 will go in the investing cash inflow. But if your transaction cost, let's assume, is 5,000, this 5,000 will be added with this 90 and it becomes 95,000. If this becomes 95,000, okay, your effective interest rate has to be less than 8%. Okay, then your total interest income would be not 38, 33, because you have to deduct 5,000 from here, the transaction cost. Okay, but this is not very relevant. I mean, this is not a part of a question. This is just they told if transaction cost is there, what would be the impact? But your answer ends here. How you record 7.2, this 5, and this 92.2. Once you understand this, mostly they will ask for year 1 or max year 2. More than that, beyond that, they do not ask the journal entries. Now, financial asset subsequent measurement. So all this while we have been discussing initial measurement, that is amortized cost, fair value at OCI, fair value profit and loss. Now subsequent measurement. Subsequent measurement also we have OCI. Again, it will be at OCI if two condition. First, business model, you are holding it, okay, you are collecting the cash flow and you are selling the financial asset. That selling has to be there for it to be recognized in OCI. But if you're not selling, then it's amortized. And your amount is principal and interest. That means it's a debt. That is the meaning of it. Now, there is no commitment to keep the asset until maturity. Then it will go in OCI. Okay, so you can realize this cash anytime by selling the asset. So this category, which category? Debt investment. Remember, you can have two types of investment, debt and equity. So you can have your financial asset through equity investment also or debt investment. This category is for debt investment. That is OCI. But you are not holding it till the end. Equity investment will not fall in this category because equity investment you are not only collecting interest and capital. Okay, so you can't even use this measurement OCI for equity investment at all. But you can make an election. If you're having an equity investment, that means if you're having a shares in a company, which is your financial asset, you can measure it at fair value through OCI. But for that, you have to make a separate election, which we'll see in section 3.34. Now, where a debt investment is measured at OCI, fair value plus transaction cost, this we know, your interest income will be to your initial measurement at your effective interest rate. We have seen that table where we have taken 8% and added with 90. That 90 is your initial measurement and we have added effective interest rate. That is your interest income, and interest paid will reduce the balance to get your year-end balance. Now, any difference between this year-end and the fair value will go to OCI. But later it can be reclassified to profit and loss from OCI because it's debt, and your fair value of the investment will be the carrying amount in your statement of financial position. I know these points, bullet points are difficult to memorize and it's difficult to make a sense, but trust me, the way to learn this is only through repetitive questions of similar nature. For example, if you are selecting financial asset, only choose which are debt investment measured at OCI, then go to amortized cost, then go to P&L, then do the same thing with equity investment, financial assets which are equity investment, OCI, P&L, amortized. Keep on doing it until you get the pattern that this is how you measure. This is the only way you can study this topic, because this is not some theory. This is actually for you to do calculation. These points are there. Now, in subsequent years, your interest income is measured based on amortized cost. Okay, not the carrying amount in subsequent years. This is illustrated in the following example, example 5, which is your extension of example 4. Let's see now. So this is Opal, who is anticipating the purchase of a large property in 8 years' time. They are investing their cash surpluses in short and long-term financial asset. Most of the financial asset they have purchased, they have maturity more than 8 years. Their financial asset is they are collecting cash flow and they are selling and reinvesting that proceed for higher return. Now you see the business model is collecting cash flow and selling. So Opal's decision to hold or sale aim to maximize returns from the portfolio of financial asset. You see? Now, example 6. debt investment at OCI. So here you see at Ken this is the same. Purchase 100,000 at 10% discount. Remember this is OCI. Earlier it was amortized. The only thing is now has been changed to OCI. They are paying an interest at 5%, redeemable at 103, effective interest rate 8%. Now they have given you the fair value of loan. Remember, whenever they have given you a fair value, understand either it is fair value through OCI or PNL, not amortized cost. Otherwise, they would not give you the fair value. This is a hint for you. So the fair value of the loan note was 95 in year 1 and 97 in year 2. Now what do you have to do? First two line. We have done this, right? 97.2 and 5, 92. Then 92 plus 7.4, that is 8% on this. 5% on 100, that is 5, and 94.6. You have to compare this 92.2 and this 94.6 with 95 and 97. Of course, the fair value is more in both the cases. So now, you see what's happening? 92 and 94 and 95 and 97. Here, it has increased. There's an increment. Carrying amount is 92.2, but fair value is 95. Difference is 2.8 plus 2.8. Here, carrying amount is less than the more than the fair value. So there's a decrease. Okay. But your interest income is unchanged from that calculated based on measurement at amortized cost. Remember, whatever is your interest income, that is this line will not change whether you use amortized or OCI. Why? It is based on this amount, brought forward balance. You will keep on carrying this to the next, not your this. But here, see, that is for first line. But when you come here, you see what's happening. Here it's 92.2. But rather than bringing brought forward balance 92.2, in year 2 you are bringing this as your brought forward balance 95. And then this becomes your closing balance 97 for your second year. Understand? Now, so in year 1 what's happening? 7.2 interest income, investing category. 2.8 will go to OCI. And it will be reclassified to P&L. Financial asset has a carrying amount of 95 because that's the fair value in year 1. Year 2, financial asset carrying amount 97, understood. There's an expense of 400 because it has decreased. Anything decreased? Expense. Debit to OCI. And 7.4 interest income in investing category. Now, activity 2. You have to explain the amount to be included in financial statements for year ended 31st December 2004 in relation to the loan asset. It's an asset. They have purchased a loan asset for 120,000. This is the amount they have bought the asset. Okay, the loan is paying them an interest annually at 6%. They are receiving 6% interest income, which is 125. Effective is 9%. They are always check the business model to decide what is the measurement basis, whether it's amortized or OCI. If they are holding they are holding the asset to collect the cash flow and sell. What does it mean? OCI. And they are meeting the contractual cash flow test, that is solely interest and principal. So this is a debt investment. Number 1, it is understood from the word loan. Okay, and second, OCI. And asset has a fair value 27,000. So now let us do activity 2. So here what's happening? First, always write with this. Because start your answer with the business model. Because your business model is to hold the financial asset for both contractual cash flow and the opportunity to sell, OCI. Number 1. Number 2, initial measurement 120. Now you will apply your effective interest method. So with this 120, you only have to do for 1 year. With this 120, you will apply effective interest, which is 9%, and this is the interest that you have to pay, 6%. So this is your carrying forward balance, but your fair value is 127. So in OCI, you will credit 3.7. So this 3.7 will go in OCI. This 10.8 interest income in investing category. Then your loan asset will be recognized in the statement of financial position 127,000. Very simple. Now let's move on to profit and loss. We did not talk so much about profit and loss. All this while we have been talking about OCI, amortized cost, OCI, amortized cost for financial asset. Why is that? Those two are very prominent. Why? Depending on business model. If you are keeping till the maturity, amortized. If you are keeping and then selling, OCI. But if it's none of the two, profit and loss. This is the third scenario. Any debt investment that does not fall in amortized or OCI will go to profit and loss. Generally, these are those debt investment that you are holding for short term and not to collect cash. Okay, so in this case, all your interest income and the fair value remeasurement will go in the investing category in your statement of profit and loss. Why? Fair value cannot go to OCI. It will go in profit and loss, but where will that fair value go? In investing category and also your interest income. Now, equity investment. All this while we have been talking about debt investment, debt investment, debt investment. If you're having a loan which is an asset for you, now let's say you are having an equity investment. By default, profit and loss. Why? Because they will not give you rise to contractual cash flow. You're not only receiving interest and principal amount. That's why. Very easy. So you will measure at fair value and you have to do remeasurement and that will go in investing category. Simple. Along with the dividend income. Here, this is equity investment. For equity investment, we receive dividend, not interest. But for loan, for debt investment, it's interest income. So it's your dividend income. Now, there is an exception for equity. Remember, this exception is only for equity investment. Okay? At initial recognition, not subsequent. Initial recognition, you can make an election. And this election is irrevocable. You can't change once you make it. That any changes in the fair value, this is only for equity instrument. Okay, any changes in the fair value that you are not holding for trading, you can recognize in OCI. But if you are holding it for trading, then it will not go in OCI, then it will go in profit and loss. Okay, now remember, if an entity makes this election, that is investment by investment basis, any dividends will go in the investing category in your profit and loss, and fair value will go in OCI. Okay, if you make this election. But for debt investment, OCI, see, if it's a debt investment, anything recorded in OCI will be reclassified to profit and loss in the future. But for equity, it will always stay in OCI. It will never go to profit and loss. Now, designation as profit and loss. Now, an entity can elect to designate their debt investment that meets the criteria. Either they fall under OCI or amortized. But still, you can make it election for it to be measured at profit and loss. Why do you make this election? So that you eliminate an accounting mismatch. Okay, accounting mismatch means, let's say, a financial liability, a linked financial liability is measured at profit and loss. So it doesn't make sense that you are recognizing, let's say, see, financial asset for you is a financial liability for someone else, right? So if that person is recording financial liability through profit and loss, and you are recording your financial asset at amortized or OCI, there's an accounting mismatch, right? So in order to avoid that mismatch, you will also recognize your financial asset at profit and loss. That election is acceptable. So this so-called fair value option is also irrevocable. Remember, if you make this election, that they are going in fair value, profit and loss, I will also make through profit and loss. It is this also, you can't change this election once you make it. Okay, now let's summarize what we have discussed through a simple diagram for financial asset. So, of course, in your exam, whether FR or SBR, you are not told to draw a diagram, but understanding this is the key to pass this standard. First question, is it only principal and interest? Your cash flow. Are you only receiving principal and interest? If your question is yes, are you holding it to collect the cash flows only? Again, if it's yes, whether it's a fair value option. If it's not a fair value option, no amortized cost. Because you're receiving interest and principal, okay, you're keeping it, you're not selling it, and no fair value option, so amortized cost. This is one way. Second way, no, it's not fair value, sorry, it's a fair value option, yes. Then it will be recognized through profit and loss. Why? Why profit and loss? See, you're not selling here. You are receiving interest and principal, but you are keeping till the maturity, and it's a fair value option, so profit and loss. In fact, all other financial assets will go through profit and loss. Now, two things we have finished. Third category. If you are not receiving any interest or principal, if it's no, still it will be recognized through profit and loss. That means it's not debt, it's an equity investment, profit and loss. But if it's principal and interest and you are keeping it to collect, okay, but if you're not, then the next question is, are you collecting the contractual cash flows only? Are you keeping it to collect the contractual cash flows only? No. Then are you keeping it to collect the cash flow and for sell? Then if it's for sell, if it's yes, fair value, then OCI. Sorry, you are keeping it and then you're selling it. That means you're not keeping it till the maturity. You're selling it before that. Okay. If it's not a fair value option, it will be through P&L. Okay. If it's a fair value option, yes, then also it can go through profit and loss. But if there is no fair value option, even if you're keeping it if you're not keeping till maturity and selling, and if there's a fair value option, okay, if there is not a fair value option, then through OCI. This is for these three things: equity investment in another entity held for the long term and designated on initial recognition. Let's say you did not keep it till maturity, you are selling it. What does it say? But you are receiving interest and principal, right? Or no? Yes. So yes, you might have a fair value option, but no. Why no? Why no fair value option? It will go through OCI. If it's no, if it's yes, profit and loss. Because sometimes even if it is through OCI, you can make an election for it to be treated through profit and loss. That's why. That's why this, if its fair value option is no, it is through OCI. This is normal. This route is normal. This one. But this way, even if the fair value option is there, yes, profit and loss. But if it's no, why OCI? Why you might say that fair value option no through OCI? Because we have equity investment also here. See, debt investment no issue, but equity investment also we have in this category. That you can make an election. Even if they are classifying as amortized or OCI, you can make an election for your equity investment to go through OCI, or that you're holding for long term or designated on initial recognition. Now, so for financial asset, using these three methods, how are you going to present your income and expense matters a lot. If it's a debt investment, your interest income, remember for debt, whatever you're receiving is your interest income. Then remeasurement to fair value. So your interest income, if it's amortized cost, that means you're keeping till the maturity, you are keeping your debt till the end. You will write your interest income under investing category in your profit and loss. Okay. Then remeasurement to fair value is not applicable for amortized cost. Then interest income for OCI, again investing category. Remeasurement to fair value, it will go to OCI. Then again interest income in investing category only, or profit and loss. Remeasurement will go in the investing category. Same. Then we have equity investment. Here we are going to have dividend income and remeasurement to fair value. Dividend income not applicable for amortized cost. No remeasurement to fair value also and under amortized. But OCI will go in investing category. And remeasurement to fair value will go to OCI. That will not be reclassified to profit and loss. It will always stay in OCI. And profit and loss, investing category. So one thing you have to notice, if anything goes to profit and loss, it will fall under investing category only. Okay, the only difference is if anything remeasurement to fair value goes to OCI, for debt investment it will be reclassified to profit and loss. For equity, it will not be reclassified to profit and loss. Now, activity 3. This is about a loan receivable. So calculate the amount to be included in financial statement for 31st December 2001, 2 and 3 regarding the loan. Okay, and also journal entry for year ended 31st December 2001. So on 1st Jan 2001, they are lending, Sparrow is lending Crow 10 million for a 3-year term. They are paying interest at 5%. They will repay 11 to Sparrow on 1st Jan 2004. Effective is 8.08%. So now let us do activity 3 on Excel. So now we are simply going to recognize the movement in the loan balance. Okay. So starting with balance brought forward. This is the balance at 1st Jan. Then we have interest. This interest will be at 8.08%. Okay. Then we have interest received and balance at 31st December. So for 3 years, 2001, 2002, 2003. So what I'm going to do, I'm going to cut all this. Okay. Let's start with the balance. So it is 10 million. I'm going to drop the 3 zeros. So I'm going to write 10,000. Means it's 10 million. Just drop down the 3 zeros, last 3 digits. And if I apply 8.08% to this, done. And then I have to deduct 5% interest on this 10,000, which is 500,000. So it is 10,308. Then this will go here. Then this is the interest. Wait. This is 0.08. 832. I will just round this up to 833. And this is 500. This is the balance. This also I will round up. And then I will put here 860. This 11,008. Okay. So you see what's happening here. Just by changing it, the rounding difference, this number changes. But it will be around 11,000 only. It should be 11,000 because you'll be repaying it at 11,000. That means 11 million. Okay. Now, so if I just write 859 here, you see this should add up to 11,000. I'm rounding it down rather than rounding it up, because remember, always my closing figure has to be the amount that they have given, amount that they are repaying at 11,000. That is 11 million. Now, what things you will recognize? You will recognize this figure, this 3, as interest income in your statement of profit and loss. Then this 3, this 500s, interest received in your statement of cash flow. And then this 3, carrying amount in your statement of financial position. Okay. So now let us do the journal entries. So the solution is out there of activity 3 right there in front of you. We started with 10,000, added this 8.08 and deducted 500, which is 5% on this, and got our balances ending at 11,000. Now this 3 figure will go as interest income in the statement of profit and loss. This 500 will go in your statement of cash flow as interest received, and this are your carrying amount of your financial asset. Now, the journal entry. So in 2001, you will debit loan receivable and you will credit bank. It's a receivable for you. That's how you are going to recognize the loan. Interest income, you will debit loan receivable and you will credit the first year's interest. Interest that you have received by cash, you will debit cash 500 and credit loan receivable 500, because from your loan receivable amount, you have to deduct how much cash you have received. Now, so that's it about financial asset, subsequent and initial measurement. Now let us move on to the impairment of financial asset. This is also a very frequently tested area, both for SBR and FR students. Okay, so the impairment loss model is different compared to your IS 36. Okay, so do not confuse the two. IFRS 9 gives guidance only on impairment of financial assets, not any asset, only financial asset. Okay, which refers to credit losses. IS 36, which is impairment of asset, will not apply to financial asset. Okay. So here what's happening? Here, impairment losses are recognized before they have arisen actually. But in IS 36, what happened? First impairment happens, then you recognize it. But here, you go by the expected impairment loss model. Now, so that's why the word expected comes. You're just expecting that this will be the loss. Expected credit loss model. Expected credit loss. They are not part of your financial reporting syllabus. Okay. But with the exception of credit loss relating to trade receivable, that will come. But in your SBR, we are going to go in depth through this credit loss model. But this credit loss for trade receivable is an assumed knowledge from your financial accounting. Okay. So you can use allowance for receivable or allowance for irrecoverable debt. Both are same. Now, impairment of trade receivable. So IFRS 9 is giving you a more simplified approach when it comes to impair your trade receivable. Only trade receivable, not any other financial asset, not your derivatives or complex financial asset. Okay. And also not just trade receivable, your contract asset from your IFRS 15. This simplification enables entity to use a provision matrix. Okay. Trade receivable will be categorized based on, for example, customer type, customer location, or commonly the time outstanding. And they will apply a percentage to each category based on how much they expect that category to have the losses. Mostly the percentages they will be given to you in the exam if ever you have to use the percentage. Why? It is based on experience. But of course, in real life, in practical world, you have to make a judgment and give your own percentages. Okay, so for example, if you are categorizing trade receivable by age, let's say you are giving 1% if not past due, 2% if less than 30 dues, 5%. The more the time period, more percentages you are giving. Okay, now expected credit loss are recognized as an allowance for irrecoverable debt by recognizing it as an expense in your operating category in your statement of profit and loss. Where are you writing in your profit and loss? In the operating category. It is an expense. So you debit your profit and loss, operating category, credit allowance for irrecoverable debt. After initial recognition, you have to either increase or decrease your allowance each year. Some year it might go down, some year it might go up, but it only comes after you initially recognize the trade receivable, not before recognizing trade receivable. Of course, you can't impair something if you have not recognized that asset. So trade receivable, when you are presenting in the statement of financial position, you will show it as a net of allowance. You will already deduct your allowance from that trade receivable and show as a net position. Example 7. Here you have the balance outstanding. Default risk is given. You have to calculate your expected credit loss. So now here there is an irrecoverable debt of 17,500 at the start of the year. They have the receivable of 1 million. Okay, so this 1 million, you see currently this much is outstanding, then from 1 to 30 days this much they have given the default risk. Simply multiply it, get the figure. This is your total loss allowance. You see, compare this loss allowance with the allowance for irrecoverable debt. It's more. You see, at the start of the year it was 17,500, but throughout the year it has decreased. So that change from 16,263 to 17,500. there has been a decrease in the loss allowance. The decrease in the loss allowance, how are you going to recognize? Debit allowance, credit, profit and loss in the operating category. 1237. That is simply 17,500 minus 16,263. That is 1237. Now, so that's it for financial asset and impairment of that financial asset. Now let us move on to financial liability. Now you are a little settled. Things will be a little easier for you to grasp since you have a good understanding of financial asset by now. Financial liability, anything that goes out of your pocket. Cash, mostly cash finance. Okay. Amortized cost or profit and loss. Okay. If held for trading or you are designated through profit and loss if you want to avoid an accounting mismatch. There is no OCI for financial liability, only these two. Now, initial measurement. Initially at fair value. Usually the transaction price. Directly attributable transaction cost, for example, issue cost, you will deduct from your liability. That is measured at amortized cost. If your liability is classified as profit and loss, any transaction cost will go as an expense in your statement of profit and loss in the financing category. Now, subsequent measurement. Most financial liabilities amortized cost using effective interest method. We have seen that for financial asset. Same way. This time it's not an interest income, it's your financial liabilities or interest expense. You have to pay their interest, which will go in the financing category in your statement of profit and loss. See, all this while the interest income that you are receiving goes in the investing category, but this time interest expense will go in the financing category. Now, in your FR exam, all financial liability amortized cost. Subsequently, it is measured at amortized cost. Now, activity 4. You will see there is a common thing with financial asset. If you have understood financial asset, this is nothing for you, just a piece of cake. So you are issuing 10 million, 5% loan notes, 200,000 is the issue cost. They are repayable at a premium of 1 million, effective is 8.85%. You have to show the interest expense over 3 years. Okay, so you start with first object. You see, 10 million is a loan, but you have to deduct the issue cost from here because you are going by the amortized cost. So 10 minus 200 is 9,800, 9.8 million. From here, you add 8.85%. This is your effective interest rate. Then you deduct the interest paid. This 5% will not be on 10 minus 200. It is on this 10 million only. 500. So it's 500, 500, 500. This amount becomes the closing opening balance for this year. And then this closing becomes opening. And until you get this 11,000. It has to be 11,000. How? You have issued at 10. You are repaying at a premium of 1 million. Premium of 1 means 10 plus 1, 11. Hence you are getting 11 million. You see? So over the 3 years, what is the total interest expense? You have to add this column, the one that you are using effective interest, not this interest paid. So this 3, if you add, it's 2.7 million. Okay? 3 years, annual interest at 5%. So if you see this 2.7, how is this made? First, 3 years annual interest, that is 500, 500, 500, that is 1.5, 1,500 plus 1 million. Why 1 million? You are borrowing at 10, you are repaying at 11. 1 extra. So 1.5 plus 1, it's 2.5 thousand. And then 200 issue cost. So 2.5 plus 200 is 2.7 million. You see? Now, derecognition. If you know the recognition, you have to know the opposite also. How do you derecognize financial asset and liability? Often this is easier compared to the recognition part. And often in exam, you are not asked so much on the derecognition part. Not in FR at least, but in SBR, yes. So it's very easy. When your contractual right to receive the cash flow expires or you are transferring the financial asset to someone. This is very easy. Okay. But if your contractual right remains, then you have to do 3 further steps. You have to see how your transfer is done. You have to see whether risks and rewards are, who is having the risk and the reward and the control. Who is having the control of that asset. Now, let's start with the transfer. When you're transferring the financial asset. Transfer means you are giving the contractual right to receive cash to third party or You are retaining the right to receive the cash flow, but you are assuming a contractual obligation to pay the cash to the third party. Now, profit or loss. When you derecognize, of course, profit and loss. That is the difference between your carrying amount of the asset that you have transferred and amount that you have received. If it's the cash that you have received, compare with it, or if you have received a new asset by selling that old asset, by transferring that old asset, then you have to adjust the difference between the cash equivalent of that new asset received. This you will recognize. This profit and loss on derecognition will go either in operating or investing category in your statement of profit and loss, depending on the nature of your financial asset. For example, are you operating in your financial asset? Is it your trading activity? Then operating category. If you are taking that financial asset for investment purpose, investing category. Profit and loss on derecognition goes to investing category. In your exam, clearly they will mention you what is the nature of financial asset. Do not worry about it. Any amount in OCI are reclassified to profit and loss, but only for debt instrument measured at OCI only. Now, factoring of receivable. So, this is about an entity having a receivable of 1 million, but they are selling it to a factor for 940,000. That means factor will collect on behalf of them. If the debtor fails to pay or they have not paid within 3 months, factor can then return the debt to the entity. So as the receivable have been sold with recourse, you can't derecognize. Why? Because you will be paid back this. See, if the debtor does not pay you within 3 months, your factor will return the debt back to you. So you can't derecognize the asset. Instead, there is a current liability loan. It's like a loan that you have taken. You have to recognize of this 940,000. So if you check the difference between this your receivable 1 million and 940, 60,000 you will recognize as an interest expense, because this is your receivable and you are selling it for 940. So this is your interest expense. If the receivable have been sold without, then you can derecognize, and this 60,000 will be your operating expense, not interest expense. Now, derecognition of financial liability, same thing. When your obligation expires, this condition is met when the debtor has discharged their liability by paying the creditor. Either they have paid the creditor with cash or any other financial asset, or debtor is legally released from the primary responsibility for the liability, either by the law or by creditor. If your liability is renegotiated with the original lender at substantially different contractual terms than the original, you have to recognize a new liability and old liability derecognize. Now you have to recognize profit and loss. Between the carrying amount of a liability that you have transferred, okay, and any amount paid for it. It could be any non-cash asset transfer. This you will recognize in the operating or the financing category depending on the nature of financial liability. Like the nature of financial asset, this also they will give you in the exam. Now, move on to the third standard. So with this, we have finished IFRS 9 also. Now we'll move on to the last standard, that is IFRS 7, which talks about the disclosure part of financial instrument. Objective is significance of financial instrument on your financial position and performance, and what are the nature and the extent of the risk from the financial instrument, and how entities will manage those risks. That's what they will disclose. Regarding disclosure of asset and liability, they will recognize this in the statement of financial position. Could be in their statement of financial position or in the notes. Okay. So for each category, they will disclose their carrying amount. Financial asset at profit and loss, those designated on initial recognition and those which must be measured at fair value. Liability at profit and loss, designated on initial, that beats the definition of held for trading. Then financial asset at amortized, financial liability at amortized, financial asset at OCI. Remember, financial liability we do not measure at OCI, okay? Then what about gain and loss? This you have to disclose either in the notes or profit and loss and OCI. Net gain or loss on financial asset and liability at profit and loss, financial asset and liability at amortized cost, financial asset measured at OCI, total interest income and expense on your financial asset can be measured at amortized or OCI, and liabilities not at profit and loss. Now, so that's it. We have this is from section B of your syllabus, financial instrument. Here we have explained the need for the accounting standard on a financial instrument, the three standard IS 32, IFRS 9 and 7. Then we have defined financial asset and financial liability, explained the factoring of receivable. Then we have gone through the categories of financial instrument, how they are measured and how gain and losses will be measured from subsequent measurement. Amortized cost, OCI and fair value through profit and loss. Okay, for equity investment, instruments that are not held for trading, you can make an election for it to be held through OCI. Now, you have to distinguish between debt and equity capital. Apply the relevant IFRS standard, okay, to the interest expense of equity, redeemable preference share and debt instrument with no conversion right and convertible debt. Now, let us summarize the lecture. So when you're accounting for financial instrument, it is covered by three standard IS 32, IFRS 9, 7. Financial instrument will result in financial asset of one entity or financial liability or equity of another entity. IS 32 gives you guidance to distinguish between financial liability and equity instrument. Financial liability is the obligation to deliver cash. Compound instrument has both the elements of liability and equity in one. You have to separately show them. Liability first you will measure by measuring them at the present value of future cash flow, and the balance is the equity component. Debt investment, that are your financial asset, you can measure them at amortized cost, OCI or profit and loss. Equity invest, profit and loss or OCI. Financial asset that you measure at fair value plus the transaction cost if classified at amortized or OCI. Transaction cost to financial asset at profit and loss will be recognized in profit and loss. Effective interest method will apply to measure at amortized cost. For debt at OCI, your interest income will be recognized in profit and loss, but the fair value remeasurement are recognized in OCI. For debt investment at profit and loss, both your interest income and fair value measurement are recognized in profit and loss. Then, an allowance for irrecoverable debt, you will measure using provision matrix. Of course, you don't have to memorize the provision matrix. All the age, percentage they will give you, and it will go in profit and loss. Financial liability at amortized or profit and loss. Financial liability initially will measure fair value less transaction cost if at OCI. Transaction cost relating to financial asset at profit and loss are recognized in profit and loss. Financial asset that you derecognize when your contractual right to cash flow expires or you are transferring the asset. Trade receivable are derecognized if you are selling without recourse. Now, financial liability is also derecognized when it is discharged. Profit and loss on derecognition of financial asset or liability is the difference between the carrying amount of the asset or liability and the consideration that you have received or paid. Disclosure are extensive and mostly it will relate to risk. There is one technical article that you have to read, that is financial instrument, that will cover your section 3 and section 5. This you will get from your ACCA global website. Thank you for watching, and I shall see you in the next lecture. So meanwhile, do not forget to subscribe to my channel, and under my FR playlist, you can watch my previous FR lectures. Thank you.